We have a team of experts here, profound professionals that will explore what responsible investing means in the world of private equity and venture capital. I'm from a pension fund group, and I can say that responsible investing, ESG, sustainable investing, is very important for us. So I welcome that the Austrian Association of Venture Capital decided to set up a panel on responsible investing. Now, my fellow panelists, starting from the left, Adam Lessing, he is now with LGT Bank Austria. He is their member of the board. Adam is a long-term professional in the Austrian finance industry. He's well known. He decided to go into retirement recently, then decided to write a book on responsible investing, but the finance industry decided he's too valuable for our business, and they called him back into the business. So welcome, Adam. Lisa Brandstetter is from Scheuch Foundation. That is a family office of an industry group in Upper Austria. Lisa is an investment manager, and she focuses on early stage investing in clean tech, impact investing, part of this in the food business, as I understand, and she will tell us more later. To my left is Gerold Permoser. Gerold Permoser is Chief Investment Officer and Chief Sustainable Officer of Erste Asset Management. He has held various positions in the financial industry in Austria. He's a respected expert. He does his homework. He reads the stuff. He will tell us more about this. And I think he experiences that the asset management industry is leading in responsible investing. So we would then start off, and I would ask Lisa to start with a brief introductory statement, and then give us an overview on what she's doing, what is relevant, what sustainable means for you, for the company. Please.
Sure. I'm working for the Scheuch Family Foundation, and not surprisingly, behind the foundation stands the Scheuch family. They're operating a business in Ried in Upper Austria in the clean tech sector. They found the company and are still running the company. And what we do in the foundation is we're managing the family assets. So it means basically we are a single family office consisting of 3 colleagues. And we do have a classical foundation asset allocation. So we invest long-term in real estate, broadly diversified bonds and equity. But what we do, and I think that not many foundations do that, we also make direct investments in early stage clean tech companies. So we act like a VC fund, but with a longer time horizon. So that gives us a little bit more flexibility in the structure and in what we do and in which kind of companies we can invest. And on the other side, as Günther already mentioned, we're also looking in the food industry at the moment, coming from a perspective from the family which was doing grants a long time. And now the world of the impact investing sphere is growing and also spreading in Austria as well. And what we have seen, maybe coming back to the crisis a little bit, our companies are as well struggling, as you can imagine, I suppose. In the morning, a lot of private equity funds have talked about how the companies are dealing with the crisis, and I think it's the same in the clean tech or in the ESG or environment impact sphere, however you would like to call it. But I think on top of it comes that those companies had a lot of attention before the pandemic. So the Green New Deal, all the things happening on the EU Commission level and also in Austria in the government sphere, we're a little bit afraid but also hopeful that this issue of climate comes back, and also the ESG, the E in ESG, so to say, because we all know that the pandemic is just one crisis. We have a lot more other crises which need to be tackled in the near future. And so what we see very concretely is that companies are dealing quite well with the crisis, especially those which are still developing the technology or the products. They can do that, but of course they will have some delays on the time frame, so they will probably need to start fundraising a little bit sooner than expected. But the big issue we see is that we have a lot of companies selling to business clients, to production industry or like that. And we fear that, I think there is reason to believe that some companies will cut capex, and they will not invest as in the same dimension as before the crisis. So it could be for those companies a little bit of delay, or maybe some will also will fail. But we are quite optimistic at the moment.
Well, thank you very much, Lisa. Adam, what would you say?
Good to thank for the introduction again. For those who don't know us, as Günther mentioned, I'm on the board of LGT Bank Austria, responsible for Central and Eastern Europe. LGT is the largest privately owned private bank in the world. We run a very large private banking operation. We run asset management for our clients. And so in terms of private equity, we now have over 34 billion of private equity investments, primarily through funds of private equity funds. So we're a direct investor in these funds with obviously large experience there, over 500 manager relationships. For today, let me make 3 key points which I believe will inform our discussion. The first one is ESG is moving into mainstream. Very clearly in private equity, this is the new trend, and I'll talk about this. The second one is, however, there are major differences by region and by size in that industry. And third, regulation and standards are proliferating and will create a real problem for the industry unless we're careful in this area. Let me make these 3 points, give you some numbers to back them up. In terms of ESG moving to the mainstream, we conduct an assessment on ESG for each of the managers we invest in. We survey these managers, and then we rate them essentially on a level from 1 poor, 2 fair, 3 good, 4 excellent. And so across our manager sample, we see that the percentage of managers rated good or excellent has increased significantly over the past 6 years. From 2014 to today, the range has increased from, let me give you the exact number, from excellent from 8 to 25% globally, from excellent or good from 27 to 64%. So more than half the managers we assess overall are good or excellent, and that percentage keeps increasing. At the same time, our survey of investors, we've surveyed about 300 investors with several hundred billion of investment private equity. More than 50% say that ultimately it is important for them that ESG is integrated in the investment process before they invest in private equity. That is, however, just sort of the overall picture. And if you dig deeper, you can see that Europe is clearly the leader in that area. So regional differences exist. Then comes Asia. The US is by far the laggard in that industry. Again, if we give you some numbers in terms of Europe, excellent or good, 81% of our managers are rated excellent or good, 63 in Asia, 46, less than half in the US. Does it mean the US is poor in ESG? No, it just means the differences are very notable. We have fantastic ESG managers in the US, but the widespread we have in Europe has not yet reached the US. Same applies in terms of size. Again, over 86% of the managers which run more than 5 billion are rated good or excellent. It simply is a question of size. If you have the size, you can afford large ESG teams you can integrate. Are small managers poor? Not at all. There are excellent small managers, but they struggle to move from what we call fair, good intentions, good philosophy, but not yet a clearly implemented strategy to integrate ESG into their either investment process or in the management of the companies. And let me give you a third point before moving back to the panel. So it's mainstream, it's very different. And then what we're seeing is regulatory and standards are proliferating. Key, of course, there is Europe, where the European Union and the Sustainable Finance Action Plan has implemented a massive, important program to force managers to disclose under the disclosure regulation and to invest according to what they say. Essentially the statement about what is the impact and will you be able to prove it. All this comes into force next year. I just had a discussion with Gerold. I think he will comment on it, that part of that might be delayed or get more complicated because the pressure on the industry to conform to these new standards is immense. At the same time, we find a proliferation of standards. There are IFC standards for impact investing. There's a new UNDP standard for impact investing. The European Union has issued their taxonomy, which may conflict with some of those statements. So for the industry to conform to all these standards, there is more pressure to conform, but it's getting more difficult. So this is the overview we see, mainstream, a bit of different regionally, and challenges in terms of regulatory and standards, which we're seeing in the industry.
Thank you, Adam. The funny thing seems to be that even though the new European sustainable regulation will put a lot of work and efforts on all of us, we all seem to like it. Gerold, do you like the new regulation?
Well, let's not exaggerate. But I think it goes well with some of the topics Adam just mentioned. Adam said that ESG sustainability is moving center stage, and I think yes, that's true, but it's also moved. And what makes it moved is regulation. And he also said that Europe is in the lead. We are clearly the area which is most exposed, most experienced, and was most transformed by ESG and sustainability. And this is also due and will be even more so due to regulation which is coming up. And he also mentioned the challenges of the new regulation. And I think it's a bit, I want it all, I want it now. And this is very difficult. But this is the main idea behind the regulation. We want to have transformation of the economy. We want to redirect capital. We need 260 billion euros a year for the next 10 to 20 years every year. And so it's a huge endeavor. And the weapon of choice of the European Union to achieve that is regulation. So right now we have thousands of pages of regulation which came up or are still coming up. I don't have any legal education besides what you do at university. Nevertheless, I had to study thousands of legal documents thousands of pages of legal documents in the last 3 years. I would have never expected them, but it's something we have to do. And this is one of the problems. Some of the regulations are already there. Some are drafted, some are enacted, some are also already applicable. For some, we do have technical standards, for some, we don't. I do not want to bore the audience, but there are 2 regulations which I think are very important to all of us and also to people listening. That's the taxonomy and that's the disclosure regulation. And I would like to go a bit deeper into them. Taxonomy, it's basically a definition of what is sustainable. We all know that sustainability can mean many different things to many different people. And of course, this is a huge challenge, but also an opportunity. And the European Union decided to harmonize that. And the taxonomy is the regulation doing that. And the disclosure is the regulation that tells us there's different market participants, what they have to disclose and how they have to disclose it, by which means. And I think what is important, given the aim of the regulation, so to redirect capital, this basically applies, we are the target group. Private equity is where this all happens, so it makes sense to get them into the regulation, and I think that it will apply to very many market participants. I will skip the part of the regulation itself. Adam mentioned that especially what concerns the disclosure, recently there was new information coming out of the European Union. That's correct. The disclosure regulation is already enacted, so it's there. We know what is in there. But the technical standards that come along with it and which clarify what we actually have to do, they will be postponed, which is, in my opinion, so do I like it? I definitely don't like this part. We have to do something which we don't know in detail what it is. So this is a huge challenge, and as the whole topic is a huge challenge, it makes it even bigger. Maybe some points which I would like to stress. There is already a discussion paper on the technical standards, and one point in there is on size. And there it says, it's a discussion paper, that there is limited scope for proportionality, which is basically something we as an industry have to keep in mind. So we are too small might not be an excuse of not doing it. So it might be a huge challenge, even bigger challenge for smaller companies. Industries, if you look at the private equity market, it's probably not so much about oil drilling or new coal-fired power plants or the cement industry. This is where the taxonomy aims at. So it will be a challenge to even know what it means, because we are right now not in most industries, I guess, which are where the private equity industry is focusing on, are not in the focus of the taxonomy. So there's a mismatch. You cannot change your portfolio. If you invest, you're probably bound for the next 10 years, but the taxonomy is something inherently dynamic, because if you want to be carbon neutral in 10, 20, 30 years, and you are not right now, there is a path. If you want to be neutral in 20 years and you are at 100%, so you have to have 5% less each year. How do you do that if you cannot change your portfolio? So it's a big challenge. I think there's also something that pertains especially to the private markets. And I think that we as an industry are the drivers of change. That's where new ideas happen. There where new ideas are financed. There where new money is going into the industry. So I'm quite convinced that given the scope of the regulation and the purpose and the goal of the regulator, it will not go away. The private equity industry, private markets as such, will be a main focus of this regulation.
Well, thank you, Gerold. I just wonder whether those of us who are regulated entities wish to work for a family office. After all, there's no regulation. So, Lisa, are you free to do in terms of responsible investing what you wish to do, or what are the guiding principles of the family?
Well, listening to all your explanations makes me a little bit afraid. So I'm very glad that we are indeed quite open in our decisions. But of course, you have to keep in mind the asset allocation, also the wishes and the direction of the family. So that's our regulatory point of view, if you wish so. We are not coming so much from the regulatory perspective, but from the impact perspective. So our goal is to maximize the impact for the given or for the risk included into the early stage marketplace. So that's challenging as well, because you never know how much the impact will be. We're not the theoretical kind of guys calculating all the KPIs, the impact measurement system that are out there. So we have to trust in the management and trust the business models they are explaining to us, and decide on a very, very subjective point of view, or from a very subjective point of view, what we think the future needs. And as you also already mentioned, that we need certain measures, we need certain technologies, and we have the challenging situation, but also the very good situation to make the decision which technology we think that will be needed in the future, and which technology will have a market. But we never know. So that's a high risk, and on the other side, we're not regulated. So it depends on how you see it. It's an advantage, but it's also a disadvantage, because we are directly measurable. So if you, as an institutional investor, I think, if you're a bank or insurance company, you do the best you can. You apply to all the regulatory issues, but you're not personally, or you don't make the investment decisions yourself. But we, on the other hand, don't have like the regulatory issues. We have to declare to, but you have the personal relation to the foundation, to the family. Yeah, so that's our point
It
of that.
makes us confident that you are a small team. You invest in early stage clean tech,
Yeah, right.
some highly technical issues, and you trust your gut feeling, you trust the business model and the people. So this is the way you are approaching it.
Exactly. So we have, of course, a top-down strategy we try to apply. At the first, we entered into the clean tech sphere, as you mentioned. It was in 2012. My colleague Ernst Ungersbeck built that up from scratch. We now have 12 investments there, quite different from a highly technology heat pump in the industry sphere, but also swimming solar panels. It's called SwimSol, the company. So it's quite diverse. And at the moment, we are looking into food and nutrition and agriculture, just to explore the market here in Austria. What's possible? Is there a kind of sweet spot we can tackle with our investments? Yeah, and of course, it's always a matter of capacity. We're a small team, as you mentioned, so we do what we can do, but we have, again, the good situation that we don't have an investment pressure, so to say. So we don't have to make investments. We don't have investors sitting in our back and wanting the return. So we have the family sitting in our backs and wanting the impact. So we have a little bit another point of view on that.
Well, how would we be measuring impact, Gerold?
Well, I think that let me yeah, I'm looking for an excuse. I think that something you mentioned is quite important to me, and I think it's we have to be a bit humble and modest in dealing with knowledge. I think that very often we do not have the knowledge, and if I think, for instance, about the disclosure regulation, if you look at the technical standards, there is a sentence in there which goes directly from melting glaciers to the impact of non-performing loans. Yeah, I think we have to be humble in what we can deliver within the next 12 months or so in knowledge. So how do we measure impact? I think that I would say there are two approaches. There is a practical approach, and I think that is something akin to what you have described. You look at regulators like alternative energy produced, jobs created in some areas where there are not that many jobs or interesting jobs, things like that. So common sense. And I think then on the other hand, you have the taxonomy, also a very regulated approach. And impact, for instance, is very clearly regulated in there. I think if you are able to produce 1 metric ton of cement, and you're able to do that without emitting 100 milligram of CO2 or CO2 equivalents, you have an impact. And so I think both things are out there. I think most likely, and also in our case, very often you have an approach like you described, microfinance, for instance. I clearly see an impact there, but it's clearly not regulated by the taxonomy. Going forward, there will be more and more regulation, and we will more and more have an idea, a very concrete and precise idea of what we mean by it. And companies will have to come up with concrete, precise numbers if they want to get access to finance.
Adam, you said that ESG is becoming mainstream. Do you think that ESG could help Europe to give a boost to the capital markets union?
Yes, absolutely. But let me come back before we move to the capital markets union to a point which Gerold raised, and it reminds me of a wonderful discussion on a panel between a member of the board of one of the large Austrian banks and a member of ESMA. And the bank complained about having to file quarterly, what he claimed amounted to 13 folders of numbers and documents, which nobody read. And ESMA replied, it's not us who want those numbers, it's you. We're happy with regulation which says don't be stupid. But you want to know, does not don't be stupid mean 9.874% or 9.875%? So make a choice. In that sense, I think that's the issue we have right now with regulation, is that to a large extent, and what we're mostly interested in as an investor in managers is to see, do they have a plan? Do they have a system in place to follow up on that plan? Do they have procedures in place and structures in place which can make that follow-up possible? Again, whether the outcome is then 8.7 milligram or 8.8 milligram is of less concern to us, because that's a level of detail which we'll never be able sort of to plan, regulate, or detail, but saying, is that credible? So for us, and we're saying that often, is the difference between somebody rated fair is, okay, you have an ESG plan, but you have no idea how to put it in place. So rated good, saying, okay, you have a structure, you have an idea, you can implement it, and it will be going somewhere. I think that's exactly what we're trying to achieve with the European regulation in terms of the disclosure regulation. The key risk we have here really is greenwashing, is that we'll have extravagant claims by investors saying, we'll achieve the world, we'll make everything greener, but in fact, all they do is invest in basic stocks. And so to me, the point of the regulatory impact is less, and the taxonomy was essentially the wish of the finance industry. They said, no, you have to tell us exactly what you mean by environmentally, otherwise we can't do it. And the wish is more saying, show us that actually you have a plan and you can implement it. So in that sense, yes, I understand the concerns, but we believe the key issue is more of a common sense of saying, can you deliver this? And the excellent managers, rather than sticking to finagling detailed numbers, is, yes, we can do it, we control, we have a relationship with our investee companies, we follow up on what they do. So yes, the taxonomy will change over time, definitely, the numbers will move, but if you follow up with your investee companies, if that will work. If you fire and forget, then clearly overall you will fail in that ESG relationship. Can it increase the capital markets union? I mean, the key issue here is, and that regulation is, the amount of money we need for the greening of the European economy is phenomenal. The numbers which are floating around are anywhere between 200, 300 billion. And while listed investments are interesting and can support, especially via engagement, the real impact essentially is our industry. This is where impact is happening. This is where new technologies are developed. This is where change is really made. So definitely, I think this is where the money will and should go. And I believe the amount of regulation we're seeing now will help making these investments more accessible to large parts of the public.
I have a question to all three of you. In what would you think should an investor expect in terms of the responsible dividend? Will it be an extra yield? Will it be a decreased yield? In terms of finance, what do you think sustainability means in the private equity venture capital world?
Let me start. I have the numbers. It's very simple. As mentioned, we've surveyed a very large part of our investors. Over 2 investors with several hundred billion of private investments. And the answer was, do you believe ESG will lead to increased risk-adjusted returns, same risk-adjusted returns, or lower risk-adjusted returns? And pleasantly for me, the vast majority, nearly 2/3 of investors say either better risk-adjusted returns or equal, no impact. I believe this shows that the fallacy we had in the early years of ESG, the early years, people had a sense it's a trade-off. It's either my money or my conviction. That essentially is gone. We're now seeing that sustainable investing essentially, on the one hand, provides opportunities which are essentially not available in the mainstream industry, and non-ESG investment essentially has risks which are significant, which you can avoid through having an ESG filter, slant, or focus. Is it always the case? No. You can have very good investments outside the ESG area, you can have poor investments in the ESG area, but overall, I believe our investors show that that is essentially becoming the mantra in industry, is it's either a level playing field or it's actually a better return because you harness more opportunities and you avoid some of the risks. Would that match your views?
Yes, it does. But I think we have, as a very early stage investor, a little bit another view on the risks in the venture capital, because taking the ESG thing aside, early stage is also always risky. So we don't have that high of expectations in terms of return. But what we do see is in other in impact investments funds, especially. We also invested in bond venture. It's in Munich, in Germany, early stage, or actually a later stage impact fund. They're doing a very good job, but and also in terms of how economically successful the companies are. But now with the crisis and the business models they have been searching and also investing into, it makes it very hard to predict how it will turn out. Just because of the sector and the business models they invested in. For example, they have a lot of digital business models, which companies turn out quite well during the crisis, but they also have a few hard tech or clean tech companies which have troubles with the supply chain or with the clients. And so I think it depends a little bit on the sector at the moment, and also in the future how each sector will perform. And not so much does impact perform well or ESG perform well or the traditional industry. I think it depends on the shift where we will, where the economy will go into the future.
I do support what Adam said. I think that there is either no impact or better performance. But I think that, and this is something that happens very often, I think, in the industry, you answer the question retroactively. You look at past performance and then you come to the conclusion, yes, there is a meta study. We went to 2,500 studies and the result is the majority proves that there is outperformance. And past outperformance is a daughter of time. It does not mean that there is future outperformance, and so we have to look at the reasons behind it. And I think that ESG and sustainability is a reaction to societal trends, to things happening in the framework, and like climate change, but not only climate change, also given COVID and the crisis, I think the social topic will come up in the next years. So things that happen in society, within our societies, and the industry reacts to it because the economy is not separate from the society. And I think that is the reason why I still believe that going forward, we will, by being ahead of these trends and not reacting to them, be able to make money out of it. At the same time, in a theoretical sense, if you look at how regulators see ESG, they see it as a risk. And normally you get compensated for taking a risk. In this case, you get compensated for not taking a risk. And this is a bit, yeah, let's think more about this.
Yeah, I think there's an academic debate going on right now on whether sustainable investing really yields a positive or a negative premium. I think the practitioners are quite assured it has to be done in a way that we get a positive dividend. And this is our approach as VBV, saying we need to find strategies, managers, private equity managers who do it in a way that we get better returns than if we did nothing. So I think this is the reconciliation. And if this spreads to the US, it could be that there comes a big wave of sustainable investing as well. What do you think, Adam?
Just let me add two quick points. I share Gerald's and probably yours, let's say, healthy cynicism for backwards-looking studies. I see wonderful studies which showed that over the past years, E has outperformed the market. Not surprisingly, if you just shorted energy with the oil price developments, guess what? I mean, yeah, I mean, these are just bad studies. More important for me, I think, is the fact that don't forget G in ESG. And the EU definition, which is incredibly important in the taxonomy regulation, is sustainable investment is either environmental and governance or social and governance. But in each case, it has to be governance. That alone, I think, yields a dividend which is non-negligible. If you invest in well-run companies and avoid the badly run companies, you should essentially, on a risk-adjusted basis, outperform. The ideal case is ours, where one of our core portfolios, the one we run for the Princely family itself, invested in a short manager who shorted Wirecard because he felt that company was poorly run. He felt that it was intransparent. Great, brilliant impact. But I think overall, I think if you focus on well-run companies, your investment should have a better return than if you disregard the G impact.
Yeah, I think we all absolutely agree that focusing on governance always has been important for the companies. But you raised social. What about socially oriented private equity venture capital? Has that ever come across your business, Lisa?
You mean what kind of social?
Private equity investments with a view on improving something social, something for society.
Yeah, I think it's a very big market. Actually, the beginning of impact investing, I think, was the social perspective in the UK and in the US, especially because they don't have like the state doing all the education work and hospitals and healthcare and stuff like that. So the impact investing world grew in these markets at the forefront. And now it's coming to Austria. And what I see here is that social startups or social businesses themselves, they have a lot of troubles here in Austria because we are used to it that we get paid for, or our children, they receive a good education, can go to the hospital, and everything that depends or is a little close to social issues, it's all taken care of. And so companies with social background here in Austria have a big challenge building up a business model that is not depending on grants or subsidies, but is really gaining or has the possibility to build a brand and to build an offer and a service where there's a market and people pay for it.
Sounds like an old discussion. We would like to have the capital, the private capital, but it should not be able to return what it should return.
Exactly.
So kind of a dilemma. But what's your view, Gerold?
I saw some, not so much in the private sector, but in the public market, and social, for instance, social bonds, and very often I'm quite skeptical because sometimes it sounds, some of these offerings sound like privatizing the social sector of the state. And for instance, financing a prison, a privately run prison, and linking the coupon to
the number of prisoners?
To the number of people who end up in prison again after some sort of some time. I know that this falls under it, and I saw these deals, but personally I'm a bit skeptical of the social impact of that. I'm not sure if this is really the social purpose we should aim for.
We could treat the issue linguistic and say social impact should not be socialist impacts, but we don't wish to politize here.
Can I just add something to that just came to my mind? I think that in the impact investing, also in ESG investing sphere, we have or many people have to believe that all the challenges can be solved with a business model. But I don't think it can be. If you look at the SDGs, there are a lot of challenges, issues, problems, which needs another form of attention, another form of money, probably, and not always a fitting business model. I don't know how you see it.
I think.
Yeah, basically. But that's the foundation of my skepticism, which I mentioned before.
Okay.
Yeah, maybe to add to this point, I think it's a mistake to think social essentially means do-gooding. You can have, I think, both business models which are sensible from a business point of view, and at the same time are incredibly important in providing private capital to areas where simply the state does not have enough capital infrastructure or resources to provide support. So just on a general basis, although of course there are areas where you should avoid sort of profiting from people's misery. We've just co-financed a very large investment in old age care homes, which are desperately needed, which can be extremely well run, which can be run on a very professional basis, and provide sort of state support where needed for those people who can't afford it. I think these are business models which fit squarely into the social area. Clearly, that's an area, again, in the regulatory side where we currently have no good definition of what in the end will be considered as social. I think that's the next chapter of taxonomy waiting to be written in that area. But certainly right now, today, we have already models in healthcare, in old age care, in schooling, which are both run on a profitable basis for investors and support developments where the state simply does not have the sources, the funds, or the speed of investing needed to have developments there, which are extremely important. So yes, it's an area we like, an area where we do invest in.
Well, we are invested in elder care homes as well, for a long time actually. We don't speak about the returns there, but the issue is a private investor or a private equity investor. We need to have security about the terms and conditions. They need not change over time because of some interference. I think this is probably one of the issues. Now, we are having here a panel on private equity, and we are facing coronavirus. We are experiencing kind of a second wave right now. We hear political statements, you should do something to help all those companies who need finance, that they don't go under, that they are able to survive. How do we see these issues? Who wishes to go first?
Well, maybe I start. I totally agree. I think that for us as an industry, this is one of the purposes we have, and I think that this is also something we need to provide solutions for. We are, and it's too early, also from a legal point of view, to talk about this. We are also thinking and working on a solution for that, and I think that this is something we will come up with in the next quarters.
Okay. Lisa?
I mean, on a very high level, we run very large secondaries funds. And the secondaries funds both provide liquidity to private equity primary investors who wish to disinvest, but also provide additional capital where the primary investor finds that they need additional capital, but their fund is closed or the investor not available. So that clearly is limited to companies with viable business models, which will be viable after a crisis. This is not sort of lost money to throw good money after bad, but ultimately where it is a liquidity problem occasioned by COVID, that's exactly where private equity in the form of secondaries can and should help, and will help in that case, support their businesses across time and not simply walk away because the model just doesn't work for the moment.
Yeah, I can also just underline that it depends on the business model. Is it like really working, or was it working before the crisis, just a liquidity issue, or is the business model itself probably not working? And then we have to distinguish between both. But what you mentioned is the government help and all the financial need. Did you mean that, or did I get that wrong?
No, not necessarily, but anyway.
Yeah, here in Austria, I think we have in general a very good governmental or state support for early stage funding, also with the FFG or AVS. But in the crisis, I think it was very troublesome for the companies to be valid to those governmental supports because it never fit the criteria, and then I think the fund was fully was completely used for all the companies. So I think that it doesn't need to be the state money, but I think that investors have to have a clear picture of which business model they want to carry through the crisis, and which you think that they can survive after the crisis as well.
Do you expect any changes in the private equity culture in Central Europe with COVID-19? For example, that companies are more susceptible to accepting private capital, take an investor on board. Do we see any changes on both sides, the investors and the investee companies?
I think, so again, very quickly, Austria is a prime example. Austria traditionally has a culture of very low equity component in the balance sheets of companies. I think the crisis demonstrated the cost of this, of simply over-leveraging a company exposes you to the long tail of risk, or especially the black swans like COVID. And so in a sense, I think the understanding that you need serious equity bolsters to survive crises has certainly been increased by the current crisis. But maybe let me add one last point, because
we have some 4 or 5 minutes, so we could go
Perfect.
into a final round anyway.
Then just so, yes, I think the need and the understanding of the need for equity as a provision against bad times has certainly increased.
Yeah, I think that as well. In the early stage startup sphere, it's like, I think, quite common because they don't receive a bank loan or any other financing, so they're used to fundraising, they're used to talking to equity investors. So I think it will not change. Maybe it will also increase because they're not getting the support other companies get from the government side or from the bank side. So I think the private equity companies are more important than ever before to support this liquidity in this crisis.
And just adding to this, do you think that those companies shall be supplying only equity or mezzanine capital as well, for example?
I think it depends on the situation, on the financial plan and the business model, what they need. So it's always depending a little bit. But equity, I think, is easier. But on the other hand, if you do like a convertible loan or something like that, it's probably better for the company or for the management, for the shareholders, because you don't have to agree on the valuation. So that's, we've seen a lot problems with how much is the company worth at the moment with this crisis, and nobody knows how the future will turn out. So it's mostly it's driven by the valuation aspect that it ends up to be a convertible or something like that.
Well, we could say, as people working on the liquid markets as well, what the valuation of certain companies has been worth has changed in April or March tremendously, just within a few days. So, well, Gerold, you have a lot of responsibility.
To zoom in on that?
Yeah, do. Yes, you wish.
I just wanted to mention Zoom. But of course, you're right. I mean, COVID has eaten into capital buffers. The capital is missing. For profitable business models, it has to come from somewhere. And this is a chance for us as an industry. And if it is a liquidity issue, it is actually a good valuation, or it's a good moment in time to invest. And I think that this will be a chance for the industry.
Yeah, I think these are very well led final words. I think this should be the belief of all of us working in the industry, being confident about the future, taking responsibility for our clients. I wish to thank the panel very much for the insight, for the open discussion. I learned a lot new. I hope our audience learned a lot new as well. Thanks, Lisa. Thanks, Adam and Gerold. Thank you very much.
Thank you.
Thank you.
Thank you.